The stock market is a scam. The stock market is a very controversial topic. Many people have made millions and many people have lost millions. In this video, we're going to dive deep to discover if this investment strategy works.
The show goes on!
Stay tuned to the end to see where we rank this investment strategy in our Themicrosearch investments leaderboard. Before we answer the big question, first we need to know Chapter 1. What is the stock market? If we search up what is the stock market, we will get this answer. Stock markets are venues where buyers and sellers meet to exchange equity shares of public corporations. Stock markets are components of a free market economy because they enable democratized access to investor trading and exchange of capital. Yeah, I'm even more confused now. Let's make it simpler. Let's say there's a new tech startup called Zoom. Zoom is developing a new video conferencing software that they believe will revolutionize the way people communicate. They need money to develop and market their software. So they decide to go public and sell shares of their company on the stock market. John is an investor who believes in Zoom's potential. He buys 100 shares of Zoom stock for $10 per share. This means that he now owns a small piece of Zoom and he is entitled to a share of the company's profit. Zoom's software is a success and the company's stock price goes up. John now has shares that are worth $15 each. He decides to sell his shares and make a profit of $500. So that's the stock market in short. You give businesses cash to expand and then the business gives you returns to keep you happy and invested. Chapter 2. Scams. There are many types of scams that investors fall for, and the main two are the pyramid scheme and Ponzi scheme. Firstly, the Ponzi scheme, which was named after the man Charles Ponzi. In 1920, he stole tens of millions of dollars by promising investors that he could double their money in 90 days. He told them he could purchase postage stamps for a lot cheaper from other countries. He claimed he could resell them in the US for a lot more. What he actually did was use new investors to pay off the old investors. With no actual business behind it, he was not making a profit. Eventually, it was difficult to find new investors, so the scheme collapsed. Now, the pyramid scheme is quite similar. The only difference is it requires an initial fee to join the scheme. It also offers incentives and benefits when you refer a friend to the scheme. With similarities to the Ponzi scheme, it essentially collapses when there are no new investors to pay off the old ones. At times, it's the investors who rob fellow investors by using several scamming techniques. Most notably, investors use a scam called pump and dump. It's essentially when an investor purchases a low-priced stock, then increases the price of it by spreading false positive statements. Eventually, people fall for it and start purchasing the stock, which will drive the stock price up. The scammer then finally dumps the stock, which means selling it. The most famous example dates back to the early 90s, when Stratton Oakmont, an investment company, artificially increased the prices of its stocks by spreading false information. They reportedly made a staggering $1 billion in profits. The owner, Jordan Belfort, served 22 months in prison due to his actions, and later a movie was made about him called The Wolf of Wall Street, with Leonardo DiCaprio playing the role of Jordan Belfort. Ironically, the movie was actually funded by stolen money by a man named Joe Lowe. Insider trading is another common scamming technique. It's when you trade based on knowledge unknown to the public. For example, Elon Musk knows that Tesla is about to release their quarterly earnings report. The results turned out better than expected. Elon tells his friends the good news, hoping they will buy a large number of Tesla shares before the report is released. Once the earnings report is released, the stock price goes up and Elon's friends will sell their shares, making a large profit. Insider trading is illegal all over the world, with prison sentences for up to 20 years and fines of $5 million. One of the most prominent cases of insider trading dates back to 2017. Chris Collins, a well-known congressman from New York, tipped off his son regarding a new drug being approved by the Food and Drug Association. Cameron Collins purchased a large quantity of stocks in the company that was awaiting approval. Once approved, stock prices significantly began to rise. Cameron sold out, making an astounding amount of $500,000 in profit. The father and son were later found guilty of insider trading. They were sentenced a total of 30 months in prison and fined $200,000. In 2007, the global financial crisis caused world governments to pass a number of reforms, including the Dodd-Frank Wall Street Reform and Consumer Protection Act. These reforms were designed to re-regulate the financial industry and prevent a similar crisis from ever happening again. Before we get to the next chapter, why not consider supporting our YouTube channel by liking this video, subscribing to Themicrosearch, and telling us your opinion on topics in the comments section down below. Thank you and enjoy the rest of the video. Chapter 3: Investing Strategies. While scrolling through social media, a lot of videos claim to be sharing all the secrets on how to become a good trader. Most of the time they teach you how to read graphs and predict when the price of stock is going to increase or decrease. Many people even sell courses to let you know all their secrets. But is there any truth in technical analysis? Or are they simply just doing it to create another pyramid scheme? Before we break down these strategies, we first need to understand the difference between trading and investing. The main difference between the two is the duration before seeing the results. Trading is a rapid buy and sell process, while investing usually involves a large amount of research and analysis, causing it to be a long time before the results appear. Capital.com is a trading platform who pride themselves on their courses. They have a vast number of users who take their advice, hoping to one day make it big and become the next Warren Buffett. Their strategies teach to read trends and patterns, such as trend momentum, trend lines, and moving strategies. They claim that if used properly, the knowledge helps understanding how stocks would perform in the future. Most critics do not believe such statements. Even experts have said that technical analysis is just mathematically incorrect. But why don't the numbers add up? Past or current prices of stocks have nothing to do with how the future of the stock market reads, which proves that current beliefs of trading technical analysts will never work. Sometimes our emotions can help with reading the stock market. This type of technical analysis is called sentimental indicator analysis. Psychology is used to attempt to guess which way the price is heading. For example, when natural disasters cause spikes in the market, panic buying and selling causes people's gut instincts to follow the movement. On the other hand, when you are looking for a long-term investment, technical analysis is very useful research, becoming the deciding factor on whether your result will be a profit or loss. Now it's time to place stock investing onto the Themicrosearch Investments Leaderboard, where we rank each strategy to see if you should invest or not. Firstly, we're ranking the initial cost to start investing in stocks. All you need to do to start investing in stocks is start up an online account for free. Then the fun begins, and you can start investing instantly, giving stock investing a perfect initial cost score of 10 out of 10. Risk. The risk associated with stock investment is astonishing. Many people have lost their life savings through stock investing. Detrimental effects, such as the 2008 stock market crash, make it very unpredictable, giving stock investing a 2 out of 10 for risk. Profit. Stock investing can be extremely profitable. However, it's hard to put an estimate on how profitable it is, seeing as it relies on so many factors. Let's say everything was going your way and you extensively studied each company. Over time, the profit would begin to show. I'd give it a solid 7 out of 10, as there are so many billionaires who got rich through stocks. Duration. You don't want to spend your whole life waiting for your investment to turn profitable. A great example is the development in Apple stock. If you bought one share 30 years ago and sold it today, the price would be around $18,000. This proves that even though the markup is huge, it heavily relies on the time frame and amount invested before turning a profit. Stock investing means you're in for the long haul, making the duration score 4 out of 10. Growth. When making an investment, it is crucial to always focus on growth. You never want to make an investment that's only good for 1 week. An investment should be sustainable for many years. I believe that if the dividends are reinvested back into the stock market wisely, certainly growth could show over time. Stock investing gets a growth score of 8 out of 10. This gives stock investing an overall score of 6.2, which puts it first on our investing leaderboard. Let's see if it holds that position against other investment strategies. In conclusion, I believe that investing in stocks could be very profitable if it's done correctly. Researching each company and putting the time into studying their portfolio can help with making educated decisions into investing or not. However, many scamming techniques both by investors and businesses can affect your decisions, so be prepared with what's to come. Thank you for watching Themicrosearch. Please like and subscribe to see more videos. Don't forget to comment below on what videos you would like to see next time.